Hello, I'm Nathan Kubik, and thank you for joining us for the end of the third quarter Transform Wealth Capital Markets Review. I hope everyone is doing well and that your fall is off to a great start. Today, we will be discussing recent events, what we are currently observing in the financial markets, as well as a number of noteworthy influencing factors moving forward. After a discussion on potential impacts from those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. We did experience some volatility in the last month of the third quarter, but the markets have remained resilient and the economy continues to drive forward. Much of that volatility can be attributed to the factors listed here, along with the rhetoric around the debt ceiling. But from a corporate strength and economic growth perspective, the continued recovery appears to remain intact. Corporate earnings are forecasted to continue their upward trajectory, which, if true, will continue to pull valuation metrics in the direction of historical averages. Interest rates remain attractive for economic growth, but the Fed's tapering and inflation could result in rates moving a bit higher. Details of any tax changes remain unknown. However, it is likely that there will be some changes made clear this quarter. COVID remains a key component throughout the markets, and while case levels are falling and vaccine rates are rising, there are still many unknowns. There are also aftermath implications we need to work through. One such example is the supply chain struggles many industries are currently working through. COVID has changed many things. Some of those changes are temporary, and some will remain. Many of those relating to corporate efficiencies will remain, and we will continue to witness those implications in the quarters to come. Confirmed cases are declining, and more individuals are becoming vaccinated. We are also witnessing changes in the workplace, and while some businesses have returned to historical practices, others have modified their approach. Remote workplace is one such example. This recession has experienced the fastest recovery in history. From an employment standpoint, this recovery is unprecedented. Unemployment levels are back below their 50-year average, and while we are not yet back to pre-pandemic levels, that is not due to the lack of available jobs. Looking at the chart on the left, we can see the magnitude of the number of job openings. There are a remarkable number of companies searching for employees. So why is it that there are more than 10 million job openings and still unemployment levels that are greater than there were pre-pandemic? In our opinion, the answer is twofold. First, it wasn't until September 6th that the additional unemployment payments ended. Looking at the chart on the right, we witnessed this dramatic decline as those claim benefits expired. The second and less clear reason is that the labor markets are going through meaningful changes. Specifically, the pandemic shifted workers' mindsets and desires, and there is now a disconnect between the jobs that are available and those that workers are looking for. Some of the disconnect is due to the mismatched industry desires. Within the US, this can be seen in the hospitality and leisure space pretty clearly. But for some workers, they want to work remotely forever. Others are using this time to shift career paths, while others still are considering more entrepreneurial endeavors. Ultimately, workers are using this period to reassess their career path, and this change is now being referred to as the Great Reassessment. In this slide, we see that there is also an increasing level of resignations. In fact, resignations are currently at a very high level. A contributing factor to this great reassessment is that the average millennial's age is now around 30 years old. There appears to be a high number of workers in this age group that are using this moment to refocus their career path. It is worth noting that this disconnect between job openings and those looking for work has led to some wage growth, and that inflationary metric is not exclusive to wages. We have also witnessed inflation across the economy. This has been a topic of conversation for some time now. As a direct result of the pandemic, supply chains have been suffering. which are compounding the already pent-up demand and extra money within the system. Here, we consider the Consumer Price Index and recognize that we have indeed been witnessing inflation. The Federal Reserve has told us that this inflation will be transitory, but for many parts of the economy, we are yet to see this being the case. Whether or not inflation is transitory is an unknown, but it does appear as though it will take longer to subside than originally estimated. That said, most analysts appear to believe that it will begin subsiding in early 2022, which, if the case, is a positive for the economy from a long-term perspective. Before moving into our equity models discussion, I wanted to take a moment to discuss the vast difference in performance between the US markets and the rest of the world. Unlike a passive management approach, which would likely have a permanent exposure to international markets, we have intentionally minimized our exposure to the international markets for over a decade now. While most investors know the S&P 500, this index is not truly a representation of the entire world's equity markets. Yes, it has been the top performing index for some time now, but it is important to realize that this is not always the case. Here, we consider the S&P 500 in blue and the rest of the world through the MSCI All Country World ex-US Index as depicted in orange. As you can see, our decision to avoid international exposures has been a rewarded decision for our investors. Looking at the same type of data through slightly different indexes and a different charting method, we see that for nearly 14 years, the US has outperformed that of the rest of the developed world. Here we see that the MSCI USA index has outperformed the MSCI EFA index by 240% over those near 14 years, and this includes the period of the pandemic. Moving into the equity markets, we did want to comment on the volatility the markets experienced in September. While none of us enjoy a market pullback, it is important to recognize that they are part of the stock market, and there will be intra-year drops each and every year. Clearly, the pandemic resulted in a meaningful downturn, but I believe this chart paints the picture for the resiliency of the US markets. It also paints the picture that while this recent volatility might have been heavily discussed in the media, in actuality, it was really just normal market movement in the face of changes, which is inherent to the equity markets. For the past several quarters, we have been discussing the expected rapid expansion of corporate earnings to justify the higher stock valuations that we have been seeing in the equity markets. Well, those high expectations appear to have been justified as corporate earnings have greatly exceeded those higher expansion expectations. In the chart on the left, consider the light blue earnings estimate levels. The first of these is the total expectation for 2021, which is meaningfully higher than they were initially forecasted to be. In fact, when considering the year-to-date 14.7% performance of the S&P 500, we see that valuation multiples have indeed declined and that earnings growth was actually up over 26% over the year-to-date. Looking at the blue line in the chart on the right, we see that earnings are in fact growing into the valuations, and that valuation multiples have actually been reduced by 11.6% over the year to date. Lastly, earnings are expected to continue to grow meaningfully, as depicted in the 2022 and 2023 blue bars in the chart on the left. While this reduction has not brought us back to the 25-year average price to earnings multiple of 16.7, it has brought us to about one standard deviation away from there. Take this piece of information, along with the consensus of analysts forecasting meaningful and continued earnings growth, and we have reason to be optimistic that we will continue this trend and that earnings will continue to grow into the current market valuations. When considering those earnings expectations and valuation metrics, it is important to understand that the S&P 500 considers the weighted average of the large cap stock market as a whole. But we must remember that the S&P 500 is made up of 505 individual stocks, and that there is a meaningful disparity in the valuations of each and every company. Some of its underlying companies have valuations that are building in incredibly high levels of earnings growth, while others are assigned valuations with expectations of no or even negative growth. In this chart, we consider that disparity. This chart weeds out the top and bottom 20% of extremes and considers the disparity between the remaining 60% of the stocks in the S&P 500. Even after weeding out the extremes, we still see a wide level of disparity. Typically, during these wider periods of dispersion, active management has a greater opportunity for outperformance, as valuation dislocations can occur, as well as the opportunities for more impactful earnings surprises. From a style perspective, we did witness another quarter in which large growth companies outperformed large value companies. This shift in leadership began in the second quarter, and the large cap growth style outperformed that of the large cap value by about 3% in the third quarter. Additionally, while large cap stocks remained relatively flat for the quarter, we did see small cap stocks decline by about 3%. While it is too early to say that this shift in style will continue for the long term, it does support our current positioning, especially when considering the earnings growth expectations that we discussed earlier. And here we consider that style positioning. As you can see, between all market caps, we are about 11% overweight to growth, with the vast majority being focused in the large cap space. We are currently in the process of placing some trades that will tighten these weightings a touch, but remain focused on positioning with a bit more growth exposure through this earnings growth driven expansion. As always, in addition to our style focus, we also focus closely on the sector and subsector levels, as those performance disparities are generally even more meaningful than that of styles. Looking at the sectors of the S&P 500, we see energy as the top performing sector for the year to date, but it did decline by about 1.7% in the third quarter. Financials was the best performing sector for the third quarter, with a gain of 2.7%. Last quarter, we discussed our overweight to financials as an area of note and described our rationale for that overweight. Ultimately, lower valuation metrics, inflationary pressures, and the potential for a rise in interest rates from tapering were the primary reasons. At least for the year to date, this overweight has worked well for our clients. In addition to financials, we also have overweights in technology, industrials, and materials. Our underweights are in communication services, utilities, and real estate. We are in the process of tweaking a few of the underlying holdings in this model and feel good about our exposures as we move into the fourth quarter. A similar story can be seen in our dividend equity model. This strategy has an inherent tilt towards large cap value, and we do believe that these types of companies have stronger fundamentals and that their valuation metrics also remain relatively attractive to the market as a whole. While this model will not tilt towards growth like the core model, we are still looking for growth characteristics within the value space. Additionally, like the core equity model, we also continue to hold a defensive portion within this model to the buffer cap strategy as well. As we are in a time period of incredibly low yields, the dividends associated with these companies, along with their strong fundamentals, should continue to look attractive and entice buyers as we move forward through 2021. We are also aware of the implications of inflation on dividend-paying companies and are thoughtfully positioning with this in mind. I will note that any tax changes do have the potential of causing us to shift our focus, but we currently feel well positioned going forward within this space. On the bond side of things, yields did experience a bit of volatility this quarter, but ended up pretty close to where they were at the end of last quarter. International bond yields remain a pressure on U.S. rates, and the Federal Reserve's ongoing easing through bond purchases has continued to hold rates at lower levels. However, the Fed has stated that they are going to start tapering those monthly bond purchases as soon as next month. Their actions to date cause us to believe that this will be a gradual and thoughtful tapering. While the tapering may result in a slight rise in interest rates, we do not believe this to have a dramatic impact going forward. Lastly, on the chart on the left, we see the historical bond purchasing by the developed markets and the forecasted tapering that is to come. While the tapering will likely be a dynamic process, we can see that the European central banks are expected to follow suit. As we approach this change, we are well positioned for the scenario that the tapering could create some buying opportunities. This continues to be a difficult time for fixed income instruments of all types, and we believe the prudent course of action to be patience, utilize some alternatives, and we are utilizing some defensive positioning in fixed income as we move forward in the expectations that rates could rise further. So in conclusion, given all available indicators and economic data, we continue to feel cautiously optimistic about what the future looks like. We feel strongly about the companies we currently own and the way that we are positioned going into the next quarter. We remain focused on potential risk exposures and are prepared to reposition should indicators shift further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented. Take care, and we look forward to speaking with you soon.